In my last video, I explained how bull markets tend to start with massive optimism around a certain theme. It was EVs back in 2021 and clean energy, and stocks like NIO and Tesla and many others went up hundreds of percent. A lot of money was made back then. Since 2022, we had the AI related theme, and a lot of money has been made with AI. And I explained how during downturns or during bear markets, if you can identify the next potential theme and buy those stocks and be early and buy them in times of fear and times of uncertainty, you could potentially make a lot of money once the market recovers and once investors start paying attention to those themes instead of crying about the year-to-date returns. So I'm going to explain two themes that I'm paying attention to. I'm invested in them. I've been talking about them for a little bit, and I believe they could take off in a major way over the next few years. And I'm going to give you two stocks ideas based on those themes. So I really hope you enjoy it as always. The first one is energy and electricity in general. This has been a theme for a while. I talked about it. I'm invested in it. But I believe it's highly underrated, especially right now with the kind of power that's required for those data centers. They consume more than 7% of total US power demand, and it's hurting the consumers so much that President Trump wanted to put in price caps on a lot of those utilities. And a lot of those stocks have been going down recently, and I believe there's a massive misunderstanding and an opportunity to be made, and it could potentially be the last time those kind of energy or electricity stocks trade at a discount relative to their future value. The second theme is Fiscal.AI. So we've been training a lot of models, doing a lot of things, and the CEO of NVIDIA himself explains that the last and final stage of AI is Fiscal.AI. So taking everything that we learned over the last few years and applying them to real life application, such as automation, drones, and many different things. And I'm going to talk about this one again. The first one was energy. My stock is Constellation Energy. I've been in Constellation Energy since 2024 from $155 per share, and I recently averaged up on the stock during the downturn. It has recovered a little bit, but it's still trading down 21% year to date, and I'm looking for more of energy stocks to buy in this downturn. But Constellation Energy is the largest unregulated utility company in the United States. They serve over 21 million homes. They have a nuclear fleet, and they also have a natural gas fleet. Now, there's a big difference between a regulated utility and unregulated utility. A regulated utility, they operate pretty much a local monopoly. You have to go through this electricity provider, but the governments, they put in price caps on how much they can charge for their electricity, which is why their growth and their margins are always predetermined. They're very predictable, but they're not going to be growing 20 or 25% because there's only so much that they can raise prices on the consumers. Now, this is different from an unregulated utility company like Constellation Energy. With unregulated utility companies, there's really no price caps. Also, price is determined based on supply and demand, and I showed you how much data centers have been consuming in terms of electricity, and the demand is way outpacing supply, and Constellation Energy and other unregulated utility companies have been making a lot of money. Now, the best part about this business model, if they have a nuclear fleet, is they don't have any price caps, but they have a floor on how much they can charge. So worst case scenario, based on the nuclear tax credits that were provided by a bipartisan bill in 2022, and those credits were provided to encourage more supply of nuclear energy, and that's why CEG has been doing well. Those credits, they put in a floor on what CEG can charge, which provides them with visibility of 13% operating earnings per share growth through 2030. And those credits, they don't expire before 2032. So in other words, those credits, which are inflation adjusted, gives Constellation Energy minimum 13% operating earnings growth, but there's no ceiling on how much Constellation Energy can charge. They can charge way beyond the 13%, which is why this business is very, very lucrative. Now, very recently, President Trump wanted to try to somewhat regulate those unregulated utility companies, and he wants to try to curb the rising electricity bills on the consumers. And CEG went down a lot on this news because supposedly he's going to put in price caps on CEG and a lot of those other providers. But I said back then that it's not going to happen, because if he's putting price caps, he's discouraging additional supply from coming online. You're going to have to give those companies the margins for them to operate the nuclear fleet, which is why the credits had a floor, but they had no ceiling. Now, I've been right so far, because he talked about this more, and he said that he wants the largest electricity grid in US to make the big tech companies pay for new power plants. So big tech companies like Amazon, and very recently Anthropic, Amazon, all those hyperscalers are the one that are going to be covering the difference in the increase in electricity prices for the consumers, but it's not going to affect Constellation Energy. So Constellation Energy can charge higher prices based on supply and demand. Instead of the consumers paying those additional prices, the hyperscalers will be paying them. But CEG owns the grid. They need CEG. They have enough electricity to power 27 million homes. So this is an amazing way to bet on it, where you're getting a floor, but you're not getting a ceiling. And the ceiling is likely not going to happen because the hyperscalers are paying the difference and not Constellation Energy itself. Now, Constellation Energy is signing deals with the hyperscalers. They signed over a 20-year deal with Meta. They have another one with Microsoft to bring back an idle nuclear plant online. And there's a lot of those idle nuclear plants, and they could provide additional revenue for Constellation Energy. But it's also worth mentioning that President Trump is going after the PGM auctions. Okay, and the PGM is only 49%, not only, but it's 49% of the combined business. Before the acquisition, it was 69%. And you have companies like Talon Energy with 93% exposure to the PGM. So CEG is much more diversified, and I'm not too worried about such actions. Now, looking at the outlook, they have 13% in base earnings. Then on top of that, I told you they can charge more based on demand. So they have something called enhanced earnings. Enhanced earnings adds a lot of additional revenues to Constellation Energy, and then they have a $2 annual contribution from the Calpine acquisition, which they recently closed it, and it's all approved, and it made CEG the largest utility company in the United States. But based on the minimum of 13%, the enhanced, I think CEG could grow at least 20% in earnings per share over the next 4 to 5 years. So I put in 1170, which is $970 plus $2, 1170 for 2026. And then I put in 4 years after for 2030, and I put in 20% operating earnings growth. I get $24.26 in earnings per share. CEG right now is trading at 25 times earnings. It was trading at 35 times not long ago. It went as low as 21, 22 times, and I bought a little bit of the dip. Now it's trading at 25 times. So if we take the number for 2030, which is 24, 26, and I time it by 25 times earnings, which is the current multiple, I'm getting $606 per share. CEG right now is trading at about $280 per share. This is about 116% on the upside over the next 5 years with an amazing company, massive tailwinds like Constellation Energy. Now, if you could ever buy CEG around 20 times earnings or below, this is when I bought the stock, it gets really interesting. 20 times earnings is around 220, 240. So you could put in a price alert. If it ever gets there, that's like too cheap to ignore. Right now, it's undervalued, but you could potentially have some downside on the multiple. And again, I'm looking for more stocks like Constellation Energies that have been going down in this market. And I share everything I do in my own group. And this is the link if you're interested. Now, the second one for Fiscal.AI and just AI in general on the physical part is mainly Ouster. I talked about Ouster before. It's down 20% year to date, and it's been executing really well. They did a lot of things, but the stock is going down. And that's, again, what happens during those downturns. A lot of those stocks, they get crushed, even if they do well, but they just get sold off with the market. Now, Ouster is the largest LiDAR sensor company in the United States, and they can apply their sensors on things like sort of robotics, which if you've seen them, so robotics is a big one for them, over $14 billion TAM. The sensor part is critical to bring physical AI to life. The eyes of AI, they need to see, they need to sense certain things for robotics, humanoids. All those things require sensors, and LiDAR sensors are the best in the game. The total market opportunity is $70 billion currently for robotics, industrial, smart infrastructure, and automotive. My favorite one is smart infrastructure because a lot of it is old in the United States, and this is mainly traffic monitoring systems. Now, the best part about this business is it doesn't only provide hardware revenue for Ouster, but also provides software revenues for those municipalities to be able, and local government, for them to monitor the traffic and monitor different things. So over the long term, this is not only a hardware business, it's also a software business. Now, the reason why I'm so excited about the stock at the moment is they acquired a company called Stereolabs. Stereolabs diversifies Ouster away from LiDAR into more such as sensing cameras, and they got an additional 10,000 plus customers through Stereolabs, and I believe that makes Ouster the ultimate physical AI related bet. Now, for Ouster, there's also some competition. But if you look at the gross margins of Ouster versus the competition, Ouster has a 45% gross margin. Innoviz, which is an Israeli company, has 16% gross margins. AEVA is negative 49%. And Luminar, which is negative 78%, but Luminar pretty much went to zero. The stock went bankrupt and they eliminated another one of their competitors. Now, the main competition for Ouster that you have to worry about is Chinese LiDAR, because Chinese LiDAR is very effective and it's much, much cheaper than American LiDAR like Ouster. But this is becoming less of a concern after the US government has pretty much blacklisted Hesai, which is the largest LiDAR player in China, because they believe Hesai is working with the Beijing military and they banned them from military and critical infrastructure applications. They cannot be used for that. But Hesai is still very popular in the United States for sensing cameras and mainly LiDAR sensors within EVs and autonomous vehicles in general, because they're very, very cheap. But very recently, there's a bill that seeks to phase out of Chinese sensors and LiDAR in self-driving cars after space hack fears. So they believe maybe in certain events of conflict, China could potentially hack those sensors from space, and they can disable all the cars in the United States and all those sensors through, because they're from China, and there's a lot of fears around it. And that makes a lot of sense. It makes it a national security priority. And if they want to phase out Chinese LiDAR, then Ouster, you could say, is the only game in town. There's maybe 2 or 3 of them. But Ouster is the largest one that provides LiDAR sensor in the United States, and they are compliant with US regulations and US manufacturing standards. So if that bill does pass, this is a major call option on the stock. But there's also a lot of risks, which is why Ouster to me is a speculative position, meaning 2 to 3% of my portfolio. If I'm right, I make a lot of money. If not, I don't lose too much. But with Ouster, they've been diluting a lot of stock. Unfortunately, shares outstanding have been expanding a lot, 15 to 20%. And I'm not a big fan of that. But the reason why Ouster is doing it is because they want a good balance sheet. Thanks to the balance sheets, they were able to acquire Stereolabs. They have $244 million of cash, and they have 0 debt. And the reason why they wanted to do that is they wanted to show their customers and their suppliers and their partners in general that they have a lot of funding, that they're not going to go to zero like Luminar, and they want to show them that they have a lot of funding and they can depend on them for very large orders. So this is why they did it, and I understand why they did it. This is still an early stage company, but again, it's not good if they continue to dilute shareholders over the long term. Now, despite the dilution, Ouster has been improving their losses sequentially almost every single quarter, from negative 95 cents in earnings per share to negative 37 cents, and it's expected to be profitable by Q1 of 2027, and it could very well happen. Now, looking at the valuation, Ouster is trading at 5 times sales. It should trade at 11, 12 times sales. I would not be surprised if it trades there again over the long term, but now trading at 5 times enterprise value to sales. And the company is guiding annually 30 to 50% annual revenue growth for the next 5 to 10 years. I believe this is easily achievable, especially with the recent expansion in cameras. It's going to more than double their total addressable market. And Ouster has been growing 40% in revenues for a while. They only have 147 million in revenues. And I'm talking to you about one of the greatest revolutions that's happening right now, which is physical AI, automation, reshoring, self-driving humanoids, and the drones, which Anduril drones for military, they use Ouster LiDAR. Amazon uses Ouster LiDAR. And it's the same thing with Google Maps. When you go on Google Maps and you're looking at a street, they use Ouster LiDAR for those things. So the potential here is massive. I think 30 to 50% is highly achievable. So this is my valuation model on Ouster. I used the 140 million expected for this year. Then for the next 10 years, because this is a long-term speculative investment, I put in 35% revenue growth. I think it's highly achievable, and they could even do 40%. But taking those numbers, I get $2.8 billion in revenues over the next 10 years. The current enterprise value of Ouster is less than $1 billion. So this is a very small company. Okay, now we're going to make two assumptions: 5 times sales and 10 times sales. The stock right now is trading at 5 times sales. So we take the 2.8 billion and we time it by 5 times sales. I'm getting a $14 billion enterprise value over the next 10 years. If I divide it by the current price of $1 billion, this is about a 14x over the next 10 years. And if you want to take in some dilution, this is like a 10x, 9x, still not a bad return to potentially 10x over the next 5 years. I think 10 years. I think this is an amazing return. But I think Ouster could potentially trade at 10 times sales. Now, taking the 2.8 billion and timing it by 10 times sales, which I believe is possible due to the company's position in such a massive revolution, especially if those bill pass to phase out Chinese LiDAR, Ouster will pretty much be his only game in town in the United States. That would take it to 28 billion enterprise value. Current enterprise value is $1 billion. So this is like a 27, 28x. If you want to take in some dilution, that's like a 20x, 19x over the next 5 years. So there's a lot of potential with this one. Great CEO, great management team, but there are still a lot of risks, which is why for me, it's a small speculative position. If I'm right, I can make a lot of money. If I'm wrong, I don't lose too much. And I'm also planning to buy more of those physical AI stocks, such as batteries, military drones, and many different things during this downturn. And if you'd like to join me on when I buy something, when I sell something, like when I bought the dips on Constellation Energy, I share everything I do in my own group, and this is the link if you're interested. But thank you again, not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.